Have you ever wondered how the rich play the game of money? How do they save and invest their money? Well, their strategies might be different from most people, of course. In business and investments, rich people have certain rules they follow to maximize their returns while also lowering the risks. Tony Robbins wrote the book Money, Master the Game to tell us these rules. The book discussed various principles and strategies used by top investors which made them so rich and successful. So stay tuned because we will discuss how you can also use the same strategies. So make sure to watch this video to the end. This is Financial Intellect, where we promote that to be finance savvy, we are your buddy. Now let's get right into the video. Where should you invest your money? This is what most of you who want to venture into investing want to find out. But you have to understand that it is not just about putting your money in one investment and expecting it to make you ultra rich at no risk. No, it is not like that. You need to understand how an investment works so that you can learn how to grow and protect your money. No one wants to invest in something that will only put you at a disadvantage. But what if I tell you that millions fall into this investment trap? Yep, you heard it right. According to Tony Robbins, 90% of American investors actually invest in mutual funds with terms that actually puts them at a disadvantage. How did this happen? Jack Bogle, the founder of Vanguard Group, says that it is all about marketing, and people usually do not do the math. Let's say you invested $10,000 when you're only 20 years old with a 7% annual return. When you turn 85, you would have roughly $574,000. Now that sounds like a lot of money, right? Well, not so much. You see, you also need to consider the fees and charges. Let's say the fee is only 2.5%. That may not sound much as of the moment, but when you're 85, you will only get $140,000 from the initial $574,000 after the fees and charges are deducted. So basically, a big percentage of your money gained went to fees and charges only. This is where most investors make a mistake. They don't pay attention to the hidden fees and charges. It might sound small in the beginning, but factor in the compound interest and that amount could be huge. This is why many rich investors also prioritize keeping their fees and charges to an absolute minimum. The cost of your dreams. Now let me ask you, how much is the cost of your dreams? How much money do you need to be financially secure, independent, and free? Take a guess and write it down. You don't have to be right, of course. Now look at your number. How much did you write? Is it $1 million, 10 million, or is it 100 million? Looking at the figure might seem a bit intimidating right now, but don't worry, we'll get into that in a minute. Humans in general have a hard time understanding big numbers. When they hear millions and billions being thrown out everywhere, they don't usually understand the magnitude of these numbers. The amount that you think you might need may actually exceed the actual amount you will need. So it is important for you to know your numbers so you can prepare. Now, let's try to calculate the costs of your dreams. 1. Financial security. How much do you need to sustain your living expenses? You have to consider your food, transportation, utilities, mortgage, and insurance. If you don't have to worry about paying for these things in your entire lifetime, how would you feel? What would your quality of life be like? It's going to be much better, right? The average basic expense of a household in the US today is around $34,000 annually. Now, to determine how much money you need to be financially secure, Tony suggests multiplying this figure by 20. The final figure is how much you need. According to Tony, there are two phases to achieve this. We have the accumulation and decumulation phase. Accumulation is the phase when you save and invest as much as you can to build up your assets. This involves higher risks as well. On the other hand, the decumulation phase is where you use those investments to sustain your living expenses without having to work. This phase usually involves pulling out of higher risk investments for a more conservative and safer return. 2. Financial freedom. Just like what we did to calculate your costs for financial security, you can also do the same to calculate how much you need for financial freedom. Know the exact amount you need in a year and multiply it by 20. The total figure is what you need to cover your expenses to live the lifestyle you want without having to work. Before we move on to the next one, if you're new to the channel, kindly give this video a like, subscribe to the channel, and turn on the notification bell so that you will know when we've posted new videos. Now let's continue with the next strategy. Actual investment strategies of rich investors. 1. Diversify. Never put all your eggs in one basket. You've probably heard of this several times before, but do you really know how important this is? David Swenson, Chief Investment Officer at Yale, says that diversifying your investment portfolio is extremely important. Just look at what happened during the market crash in 2008, where lots of people lost their retirement money, savings, and even their home. It was a dark time for everyone, except for Ray Dalio. Ray, a billionaire investor and hedge fund manager, only lost 3.9% during the market crash. And this loss can even be offset by the gains he made over the years. So in the long run, he actually still made money from the market. 2. Smart investing. In investing, you need to be smart with your moves. You need to have investment buckets to cover you in case something happens to the market. You need to have a secure bucket and a risk growth bucket. The secure bucket involves those investments that do not yield returns but also do not involve too many risks. So in case the market drops, you won't lose much. Examples of these secure investments are bonds, money markets, CDs, pensions, low-interest annuities, and security notes. Your risk growth bucket is where you can be more aggressive in taking risks so you can get higher returns. Examples of this are real estate and equities like ETFs, stocks, and mutual fund indexes. This is where a lot of people usually make the deadly mistake. They risk all their money in this bucket, so when the market drops, they'll likely lose all their money as well. The third one, the dream bucket, is optional, but is definitely as important as the other two. This is where you put your money to spend and enjoy. This investment bucket is there to help you afford a better quality of life, whether that be going on vacations, frequent date nights, or buying your dream home. So instead of dipping into your secure and risk growth bucket to fund your dreams, why not prepare one just for your dreams? 3 things to consider when taking risks. 1. Stage in life. Before taking risks, determine how much time you have ahead of you. If you're younger, you can take as many risks and be as aggressive as you want. This is because you still have enough time to recover the loss in case you will fail. 2. Liquidity. Make sure you have enough funds to cover yourself in case you make more mistakes. Look at your cash inflow minus your expenses. If there is a good gap, then you can afford to take more risks and recover your losses, just in case. 3. Risk tolerance. This refers to the level of risk you're comfortable with. Some are comfortable taking conservative risks, while some are a bit aggressive. It all depends on you and what gives you peace of mind. The best investors out there understand these risks and know when to gamble. They have an asset allocation portfolio to protect their money in case something happens to the market. You should also do the same. Before taking risks, before putting your hard-earned money in the line, think about the things we discussed here. This would guide you to make a better decision when it comes to investing. And that is how the ultra-rich win the game of money. What are your thoughts on their principles and strategies? Do you agree? Or have you always done the same strategies when investing? Let us know in the comment section below. We'd love to hear what you think about these strategies. And with that, thank you very much for watching. If you like what you've watched, stay tuned for more videos. Bye, financial buddies!